Alright, today I'm going to critique and react with somebody named Professor Oak. I don't know him very well. I did run across his YouTube channel. Young guy. He's in real estate. I'm just wanting to get to learn a little bit about him. I'm watching one of his videos. I want to share that with you. I want to kind of critique it and react to it and see what you think. And it's How to Invest in Real Estate, a Beginner's Guide. I just want to see what his viewpoint is and go from there. And when it comes to you guys, tell me what you think. Put it in the chats. Let's see what we got. What's going on, real estate investors? Before we get to the next video, I'm going to make a quick announcement. I do have an ebook out to help you out through your real estate journey. So if you want more information, click the link down in the description below. Let's get to the next video.
So today I wanted to give you guys a little primer on investing in real estate. This is going to be more of a beginner's guide, so I'm going to do a broad overview on many different types of real estate investing and lay out the different options for you guys without going too deep into any specific one of them. For those of you guys that are new here, I focused the past 2 years the majority of my equity position in real estate, and so my real estate investments right now are definitely my greatest asset class within my investment portfolio. So as we walk through the different types of real estate investing, I'm also going to give you guys my quick take and my thoughts on whether or not each type of real estate investing might be the best fit for you. Real estate is something that you can get creative with, and you can call it whatever you want. And so there's many different types of investing in real estate. And this is just a list that I've come up with that I would say is pretty comprehensive and covers the most common types of real estate, as well as the ones that probably make the most sense if you're a beginner just starting out. Now, if you're wondering why someone would want to invest in real estate in the first place, there's a couple of key advantages that I want to just touch on before we jump into this list. The first one is that real estate is an appreciating asset, and it's an asset class that performs extraordinarily well when you compare it to other ones. Market volatility, including with real estate, is something that you can't predict. But I would say if you're looking for a long-term investment that's going to be somewhat stable, then real estate historically has performed a lot better than many other asset classes out there. The second key advantage is that real estate allows you to generate passive income. Now, I'm someone that believes that there's no such thing as real passive income because every type of income that you have probably has some sort of work involved, especially in the beginning. But at the end of the day, real estate is definitely a driver of a lot of passive income for many people. And it's definitely a great way to get started with passive income without taking on too much risk.
Okay, so a large part of my financial portfolio is real estate investing. I don't do the buy and hold. I don't do the fix and flip. I used to back in the day, but a lot of mine is passive income through the buy and hold strategy. I have a tenant and I rent it out. So I have multiple single families and apartment complexes, units. So it is passive. You set it up one time and then after that, you get a check coming in on the first of every single month. Is there work that needs to get done in between there? Yes, there is, but I hire people to do this stuff. I don't go out there and work on my properties, right? So the name of the game is working on your business and not in your business. So let's continue.
The other advantages with investing in real estate include that you get a leveraged return on your investment because real estate is largely involved with financing. You get leveraged returns when you sell a property. There's oftentimes tax advantages, which include interest deductions, capital gains and depreciation write-offs, and other different codes you can take advantage of, including 1031 exchanges and other programs that allow you to maximize your equity position or keep your money in the investments that matter the most to you. So now that we have an idea for why real estate is such a good investment in the first place, let's jump into what the different types of real estate investing actually are and break down how you can get started in each of them.
So one other advantage of real estate investing is the equity capture. This is really important because if you're getting into real estate investing, you need to know how to grow your money exponentially. It's one thing that it grows and over time, over appreciation, but you get what you call this equity capture, and you can take that equity capture tax-free, turn around, pull it out of your property and go get you another deal and still keep that same property that you pulled the equity out of. That's what makes it such a beauty, right? Because you can pull that money out and go get other deals and do it exponentially. All right, so let's continue.
The first one that I want to talk about that's very popular these days is flipping real estate. What flipping real estate or flipping a house is very similar to what you see on HGTV, and a major portion of what a lot of experienced real estate investors will say is a quick way to make money. The idea is that you're able to buy a home at a certain price and sell it for a higher one within a short time period and having your gross margin be the difference in between. Now, that's probably the simplest way you can describe it because there's a lot of different things that go into actually flipping it, and your gross margin in flipping the property is not just going to be what the improvements are that you've done to it. There's a lot of costs associated with actually exiting the market and actually financing the deal and the costs you have to pay to actually hold the property during the time it's getting fixed.
So he's making a good point. Your costs can be quite expensive. Also, that can make it even more so risky. So when you start doing this fix and flip, don't always believe what the YouTube channels and the TV shows show you. There's expenses that are carried along with it that are really overlooked. Like, for example, brokerage fees, holding the property, so there's going to be vacancies, so they got to pay the expense each month, utilities to keep the lights on so the contractors can work on it. These are hidden expenses that they don't really talk about. So fix and flip is one strategy, but you really have to know what you're doing and you have to have a game plan in place so you can minimize your expenses.
I would say that in general, for beginners, flipping a property is not the best route to go, especially when you're just starting out, because generally speaking, it does take a lot of capital because banks are usually not willing to finance a large portion of an investment, especially if it's financed as an investment property and you don't have the money to put down, let's say 20% or a significant portion of the down payment. Now, ironically, the second property that I got was actually intended to be an investment flip. This was supposed to take less than 6 months, finance the deal, hard money, sourced the contractors, got the work done, flipped the property and turned it into great shape, put it back on the market, and interest rates went up, and here we are today. So that's a good segue into what I would say is the risks of flipping houses. While the idea is that you can turn a profit in a very short time frame, you simply cannot predict where the market's going to be in a year or even 6 months from now. With as fast as the Fed has increased the rates during this last year, the velocity at which homes are getting sold in the last year have dropped off dramatically. And if you're someone like me that's been caught up in a real estate flip, when you had bought it at a market high and are now trying to sell it, when interest rates are high and it's now a buyer's market, you're probably going to have a tough time selling it for what your target ARV is going to be. So once again, I'd say that flipping is probably not the route to go, especially if you're just starting out, but it is an option if you do have that equity position and are able to put in all the work, especially if you have contractor contacts, and know for a fact that you're getting a property at such a good deal, whether it's off market or even on the MLS, that you have enough of a margin buffer in case something happens with the market that you're still able to sell it for a profit. There's many.
Yeah, so he's making a good point. It really, all in all your stars must be aligned, basically, right? To make this work out when it comes to the fix and flip strategy. I don't recommend it personally for a new real estate investor. That's just my opinion. Too many risks involved, especially with this uncertain market and the economy. Things are going up. Even material is going up and supplies. So I don't know how much of an advantage that would be. Again, I'm really big into the buy and hold strategy. And when you do that, you can weather the storm of the economy. When it comes back, you can ride the wave. That's the key.
Generally speaking, rentals are a lot less riskier than purchasing a flip, just because for one, you're usually not leveraged as much as you are in an investment flip. In a traditional purchase for a rental property, you put down the 20%, and if you finance it as an investment property, you will need to have that 20% down payment in order to secure the loan. The homework you need to do on your end before you actually purchase a rental is calculating what the rents are at market rate in the area, as well as the monthly payment you're going to have for purchasing the property at the current interest rate, as well as considering the down payment that you're putting down on the property. So let's say you purchase a home for $500,000 and the down payment is 20%. You do that, and it's going to be $4,000 a month with your mortgage, your taxes, the interest payments, and any HOA fees. You then look at the market rate for rents in the area. Let's say it's a 3-bed, 2-bath house or a 4-bed, 3-bath house. What is the market rate for rents for that size property in that specific area? You take a look at the comps, and if it makes sense, especially if you'd be turning a profit just for renting it out at the market rate, then I would say you're looking at a possibility of a pretty good deal. Now, rentals are pretty solid through most markets, the primary risk being vacancy. So if you're not able to rent out your property, you need to account for a possible vacancy that you need to pay the mortgage yourself without collecting rent for those specific months. In addition, you're going to have to account for any property improvements you're going to need to make, especially if anything breaks in the home, especially when your tenants are living in it. It's something you need to get addressed immediately. Another way to go about doing rentals is to buy a property, whether it's on the MLS or off market, that needs a lot of work that you already know has intrinsic value. You then make those improvements so the property's much nicer, and then once it's rented out, you're actually able to refinance the property so it's appraised at a higher value, and you can refinance and take the cash out that you have in it. That's what's commonly known on YouTube as the BRRRR strategy, and something that works well, especially if you get a property for a really good deal in the beginning and get the work done for a reasonable price, so that on the back end, you can do that cash out refi and then put your money towards another investment property.
That's what I was saying earlier. Beauty of the buy and hold strategy. You get to hold on these properties. It goes up in equity capture. You take that equity capture to go off, go get you another deal. That's the beauty of the buy and hold. Whereas fix and flip, you can't really do that.
Is that you generally have to buy a property that's really distressed and needs a lot of work. And generally speaking, realtors or even other investors are not going to touch a property that has, foundation issues or has been vacant for I don't know how many years or just in a really bad area. So from the get-go, it's a much more risky strategy than buying a property in a great neighborhood that has pretty good comps for rents especially, and then renting it out that way. But again, that is another option for you guys out there that do have, let's say, an off-market deal that's really good, or looking for that type of situation where you're able to put in that sweat equity and improve the property over time. Like I said at the beginning of the video, there's so many different ways you can get creative with real estate. Specifically for the rental strategy, there's another way you can go about doing it, which is called the house hack. So essentially what I'm doing right now with my primary residence is a house hack. So I purchased a 3-bed, 2-bath house, and it's financed as my primary residence because I do live there. And what I've done is I've rented out the 2 other rooms that I don't live in to tenants that pay me rent every month and help offset the mortgage payments. Now, due to the recent tax assessment and the property value going way up from what it was, the rent I'm collecting from my tenants is no longer going to cover the entire mortgage payment. But that being said, it can minimize or even reduce your monthly payment to 0 for owning a property just by having other tenants living in the property with you and collecting rent at a market rate or a reasonable amount of rent. I'd say house hacking is also fairly common these days, but it's definitely a strategy that works, especially if you're a newer investor, just because you can use a different financing strategy to put less money down and then use the income you're getting from the rents in order to help make those monthly payments. At the end of the day, all the rent you're collecting is going towards the equity that you have in the property. So 10, 20 years down the line, once you have 100% equity in the property and you own it free and clear, then you can rent it out for whatever you'd like, and all the money that you're making would be directly passive income. So that.
All right, good point. And even at the very beginning, during this section, he mentioned about maintenance. Well, that's why you got to do the BRRRR strategy, and you fix everything up front first. right? So you're borrowing and leveraging other people's money, right? To be able to make this happen, you have to use this certain type of loan where it takes care of the purchase price, closing costs, and the rehab costs. And like I said, you're fixing everything up front at the very beginning because you know you're gonna have to rent this thing out. So as long as you fix everything up front at the very beginning, that lowers your risk. That means you're not going to have a lot of maintenance at the end of the term, at least for the first year, once you fix everything up. And then also, he hit it around the nail. When you're doing this buy and hold strategy, the whole point is you're fixing the property up. Once it's fixed up, you're going to turn around, put a tenant in there, and the name of the game is passive income. That way you get a check coming in your bank account every single month on the first.
Next one I want to talk about is syndication. What I mean by syndication is going in on a real estate deal with other partners that you're investing with, and the difference is going to be who are the general partners and who are the limited partners. The idea here is that you're able to purchase a property that's sometimes a commercial property, which is a big difference also from residential, in that a commercial property has 5 or more units and residential is 1 to 4. Generally with commercial properties, we're talking about, let's say, an apartment complex. Let's say it has 33, 40 units, it could be upwards of $10, $20 million. Generally speaking, most people, especially if you're just starting out in real estate investing, are not going to have the equity to put a down payment on a $20, $30 million property. Now, in order to buy that property, if you go in with other investors and you syndicate the money, so that essentially all the investors are pooling their money for that down payment, and they're splitting the returns on their investment, whether that be through rents or whatever they're doing to increase the net operating income of that property. Now, syndication is definitely popular among investors that are a little bit more established and have a better equity position because it also lowers your risk portfolio as you're not the only investor that has the most significant equity stake in a property. That reminds me of another benefit of investing in real estate, and that's that it's a hedge against inflation. Especially when you're not the sole investor in investment property. Generally speaking, the real estate market outperforms other asset classes in the long run, as we just talked about. And instead of having your money parked in the bank, assuming that your property is appreciating in value, you're getting more equity in your property just from owning it and not losing money through inflation by having the money parked in a situation where it's only making 1 or 2% every year.
So as they do syndication, so you have one person, I guess, that says, hey, look, I want to raise money to do a deal. So the good thing is, as I'm raising money to do the deal, guess what? All my other partners, what's good about it is they are passive investors. They don't have to do the hiring, the firing, they don't have to do screening, they don't have to answer phone calls. That's the good thing. That's how you can get into real estate, by getting in with a syndication, an individual that's raising money to do these apartment complexes. How would I know? Because I've done it before. So that's a nice position to be in as a passive investor, and all you're doing is lend your money to an approved individual that knows about real estate investing, is taking on a deal, and you're being passive in the deal. You're just funding the money for the deal, and that's very good. Like I said, you can get great returns, especially better than a bank. And you get some type of tax write-offs too as well when you can do that. Not a whole lot, not as much as the person that created the syndication, but it has its benefits to be a passive investor in real estate and multifamily.
So the next one I want to talk about is REITs. So this is real estate investment trusts. There's also real estate investment groups, but I'm just going to lump them together because they're really not that different. In terms of the types of returns you're going to see as an investor, I would say they're fairly similar. And for REITs, it's almost like investing in a broad market index fund or an ETF, because generally what it is that a company owns a lot of income producing real estate, which can include commercial real estate like office space, apartment complexes, warehouses, shopping centers, you name it. And instead of actually having to engage in each real estate deal yourself, you're investing in the REIT as a form of a stock, and generally they pay out dividends every month or every quarter, just like a regular stock would. Again, the returns on this are generally pretty moderate, and you wouldn't see 30% appreciation in a year like you would with a property in 2021, or the ridiculous gains that you might make from flipping a property and making 20-30% on your initial investment. But again, REITs are a way to invest in real estate without actually being hands-on, with having to engage in the actual transaction of buying and selling real estate.
Now, he's making a good point about REITs. You're not really into the react to the deal of the process. At the same time, you're going to get less than moderate returns. Okay, I know this because I was going to do them. I know about REITs. And just in my opinion, I like to have my money working for me. And to me, it's just better to get into single family houses, start getting into that, because you can get a greater return and have your money really working for you. REITs, I don't want to tie my money into a REIT because I'm funding my money, but I'm getting a very little bit in return as I do that. So again, I like to do specifically single family houses and apartment complexes. So it's a hybrid between the two, and I can get much further greater returns. And if I'm active in the single family, which I am, and have my own, there's a whole lot of tax benefits I get. Because at the end of the day, the whole point of doing real estate investing or any type of investing is to get great returns and have exponential growth on your money, having your money work for you in these investment deals.
Last one that I'll touch on briefly is just online platforms. So there's things like Fundrise where you can invest in real estate with other partners. So it's almost similar to syndication, except that it's online. And so many people can access this platform. And so your equity stake will be a lot lower, in addition to your risk portfolio being a lot lower. But again, generally speaking, the lower your risk portfolio, portfolio, the lower your possibility of a great return, as goes with investing in individual stocks versus broad market index funds.
So again, to me, my money gets watered down. When I start getting into REITs and CDs and these platforms, I have no control over it. Just to me, I wouldn't do that. I guess also because I've been in the real estate game for a long time and I like the sense of having some type of control and organization, as well as having some tax write-offs and benefits in return. So that's just me. I don't like to be too much of a passive investor, but I like to be more active so I can have my money working for me, because that's really, again, the name of the game. That's why you get into investing, because you want your money working for you. If it's in these other platforms, they just get watered down and it's not into use, in my opinion.
So if we look back at our list of the different types of real estate investments, I would say if I were to rank them in order from most risky to least risky, I would say it's definitely flipping, then rentals, then syndication, and then REITs, and then online platforms. In that same order, I would say that with higher risk is the possibility of higher return on your investment and higher reward. But again, if you're just starting out and investing in real estate, or if you don't have a ton of equity and you're trying to build that up and then invest in more real estate, I would say that the best route to go down in the form of a real estate investment in terms of this list would be some form of a rental. Whether that's through house hacking and offsetting your mortgage payments through collecting rent from your tenants, or just buying a turnkey property, putting 20% down and renting that out for the long term. If you purchase it in a great area, you can usually bank on pretty good market appreciation over the long term. And as you build equity in a property, you can then do a cash out refinance once you've got enough equity in it to then put that money towards another real estate investment. I would say in terms of my strategy right now, well, number one, it's to sell the condo that I have in San Francisco that was supposed to be a real estate flip. That's going to cost me a lot in terms of the monthly payments I'll have to make, even if I do rent it out, because the mortgage payments are already a lot higher than what the market rate is for rent. But more or less, I pretty much am forced to turn that into a rental because it's currently not selling. But once I've built up more of an equity position, I do really want to focus on sourcing off-market deals, especially with distressed properties that need a lot of work, because to me, there's a lot of fulfillment in turning a property that's really not that great and needs a ton of work into something that's really nice and I would want to live in myself, in addition to the fact that I'm building forced appreciation and my equity position in the property at that point. I would say that I'm never selling my primary residence because I bought it in a great area and a great neighborhood for a reason, so that over time I'll be able to build my equity position in that property just by renting it out, as well as living in it myself.
So also, you got to keep in mind, it's also depending on where you're at and your financial journey. I know when I started out when I was younger, I could take those risks so it didn't matter. So I could do fix and flip. And if I did lose money, it was still okay because I still had years to compensate and make up for it. See, when you get older, you don't really want to, this is just my opinion, I'm not a financial advisor or CPA, but there's less risk that you need to be taking because you don't want to lose what you have. So you got to be in more of the conservative mode, maybe doing a passive in a syndication. These are the things you got to keep in mind too, like where you're at in your real estate and investment journey. And your age has something to do with it. Your risk, your real estate investment type, or your investment type. Those things are very important. So you got to keep that in mind.
Or if you're interested in possibly investing together, do let me know. I'm always interested in the prospect of working with a partner. But until next time, thank you guys for watching, and I'll see you all in the next one.
I like what he has to say. Some of the stuff I agree with, and some of it's kind of questionable. But yeah, he's making some good points. Me personally, I really like the buy and hold strategy. I think that's very effective. Or the fix and flip when you're first starting out if you need cash flow or if you need a cash reserve. But at the end of the day, in my opinion, when you do this buy and hold strategy and rent them out, you can weather the storm of a bad economy because you're getting cash flow every single month. The property is going to go up in value. You take the equity out, go get you another deal. You still get to keep that property and it's still going to cash flow. That's just my opinion. It's been working for me for the last 22 years and continuing on. All right, guys, thank you for joining. Hopefully this brought you some value and you learned something new.